Did your bank app ever ask you to update your income to unlock better offers? Sounds helpful, but what if those offers are actually designed to make the bank more money from you? Today, we're breaking down why banks want your salary so badly and why you shouldn't tell your income to your bank. Banks already know more about your financial life than you might think. Every time you swipe your card, pay a bill, or transfer money, that data is recorded. Over time, banks can clearly see your spending habits, where you shop, how often you eat out, whether you save regularly, and even when you start struggling to keep up with payments. But there's one important piece of the puzzle they don't always know for sure: your current income. Because modern freelancing, side hustles, and frequent job changes have made income much harder to track, banks have started asking customers directly to update their income inside mobile apps or online banking portals. From the bank's perspective, this makes perfect sense. Self-reported income is quick to collect, costs almost nothing to verify in many cases, and gives their internal systems fresh information to work with. Once updated, this data can be used to decide what kind of products to offer you, how much credit exposure to give you, and how aggressively to market new financial services. The key thing to understand is that these updates are not always about helping you manage money better. Often, they help banks better understand your financial capacity, meaning how much you can borrow, spend, or repay. And when institutions have clearer visibility into your earning power, they can design offers and limits that are optimized not just for convenience, but also for their own profitability. One of the most common ways income updates can affect you is through changes in your credit limits. When a bank believes you are earning more, it may offer you a higher credit card limit. You suddenly have more purchasing power, more flexibility in emergencies, and sometimes even access to premium benefits. But higher limits also come with a hidden downside. The more credit available to you, the easier it becomes to spend beyond your comfort zone, a trap known as lifestyle creep. From the bank's point of view, higher usage often means more interest income and transaction fees. Let's make this real. Imagine you update your income from $60,000 to $90,000 inside your banking app. Within weeks, your credit limit gets raised from $5,000 to $15,000. The bank starts sending you offers for personal loans and premium cards. It feels like a reward, but here's what quietly happens next. Research shows that when credit limits increase, average spending increases with them. So instead of saving that extra $30,000 in annual income, you gradually expand your lifestyle to match your new limit. Within a year, you're carrying $8,000 in credit card debt at 20% interest. That's $1,600 every year just in interest on money you never planned to borrow. All that because of a number you decided to update. Another subtle impact is how income data can influence pricing. Some financial institutions use models that estimate how much financial pressure a customer can realistically handle. If your reported income is higher, systems may assume that you can manage slightly higher charges or additional borrowing. Higher income doesn't always mean better terms. Banks use income data to estimate something called ability to pay pricing. High-income individuals are less likely to notice a small difference in percentage points. The algorithm understands this and adjusts accordingly, so your higher income can actually make you a more expensive customer to serve. This doesn't always mean you'll be treated unfairly, but it does mean offers may be structured around your perceived ability to pay, not just your risk level. Income information also helps banks decide who should receive targeted product promotions. Customers who fall into certain earning ranges may start receiving frequent messages about personal loans, premium cards, or investment products. While some of these offers can be useful, constant upselling can slowly push people toward taking on more financial commitments than they originally intended. Not every income request from your bank carries the same importance. In some situations, sharing your income is genuinely necessary. For example, when you apply for a loan, a credit card, or mortgage, banks are required to assess whether you can realistically repay the amount you're asking for. This is part of responsible lending practices and helps reduce the chance of both customer defaults and financial system risks. In these cases, income disclosure is usually expected and sometimes legally required. However, many of the income update prompts you see inside banking apps are different. These often appear as routine notifications with messages like "improve your experience," "unlock better offers," or "keep your profile updated." Unlike formal applications, these updates are typically voluntary. You're not opening a new credit facility and you're not under immediate regulatory scrutiny. This means you often have the option to skip, delay, or provide only limited information. Understanding this decision can help you make more strategic decisions. Automatically sharing every financial detail might feel responsible, but it isn't always necessary. At the same time, completely ignoring required disclosures can create problems when you genuinely need access to credit or financial services. The smarter approach is to pause and ask a simple question. Why is the bank asking for this right now? If the request is tied to a specific product you want, sharing accurate information makes sense. But if it's a general profile update with no clear benefit, taking a more cautious approach can help you maintain greater control over your financial privacy and future options. If you want to handle income update requests more confidently, it helps to follow a simple strategy instead of reacting instantly. The first step is to pause. Many banking notifications are designed to create urgency, making you feel like you must respond immediately. In reality, you usually have time to understand why the information is being requested. Check whether the update is linked to a product you actually applied for or if it's just a general profile prompt. If you do need to share income details, try to provide only what is necessary. For example, some people choose to report their fixed base salary instead of including bonuses, side income, or irregular earnings, unless specifically required. This keeps your information accurate while avoiding unnecessary oversharing. The goal isn't to mislead the bank, but to stay practical about what level of detail is truly needed. It's also smart to observe what happens after you update your information. Over the next few weeks, pay attention to changes such as new credit limit offers, different loan promotions, or shifts in fees and messaging. This can help you understand how your data is being used and whether the update actually benefits you. Another approach some people use is to avoid concentrating all their financial activity in one place. Maintaining relationships with more than one financial institution can provide flexibility and reduce dependency on a single provider's data-driven decisions. Alongside this, relying more on savings buffers and controlled credit usage can give you stronger negotiating power. Because when you don't urgently need borrowing, you can be more selective about what information you choose to share. Sharing income information might seem like a small, one-time action, but its effects can last much longer than you expect. Banks and financial institutions use advanced data systems to build detailed customer profiles over time. This doesn't mean something negative will happen immediately. Your credit score may remain the same, your account continues normally, and offers might even look more attractive. But behind the scenes, your financial profile is becoming more defined. With clearer insights into your earning capacity, institutions can fine-tune the timing and structure of their product recommendations. Over months or even years, this can influence the types of opportunities and obligations that come your way. Because of this, some individuals prefer to explore alternatives that involve less data sharing. Smaller, member-focused institutions like credit unions or certain financial technology platforms sometimes operate with simpler product structures and avoid those aggressive marketing cycles. At the same time, building personal financial stability through emergency savings can reduce the need to rely heavily on credit products in the first place. When you have stronger cash reserves and fewer urgent borrowing needs, you gain more control. You can evaluate offers calmly, choose what truly benefits you, and decide more confidently how much personal information you're comfortable sharing. At the end of the day, the goal isn't to fear your bank or avoid every financial product. The real advantage comes from understanding how the system works so you can make smarter choices. Staying aware of how your data is used helps you protect your financial flexibility and avoid unnecessary commitments. You don't need to become an expert overnight. Just being more mindful already puts you ahead of most customers.